Welcome to our topic, today's topic, capital reporting requirement as per Basel Norms and RBI guidance. We welcome our speaker Gayathri S B to occupy dais. I request all to please rise for our motto song.
सुप्तेषु जागृति एष सुप्तेषु जागृति कामं 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 कामुषो पुरुषो निर्विमाणः तदेव शुक्रं ब्रह्मा
Please be seated. Truthful video will be played.
Arthashastram, Dharmashastram cha. Mean, economic principles, earth, and ethical considerations, dharma, which are central to the work of accountants. The entire world is deliberating about impact of climate change coupled with disruptions of artificial intelligence. India has given philosophy of Vasudhaiva Kutumbakam to the world and successfully hosted G20 summit on this theme and also launched Global Biofuels Alliance. The accounting profession also has an enormous responsibility to guide the work, where accountability meets innovation so that vision can be converted into solution. The Institute of Chartered Accountants of India, being the world's largest accounting body after the successful hosting of WCOA 2022 and GLOBAC, proudly presents before the world World Forum of Accountants 2025. Where accountability meets innovation for a sustainable planet. The world's brightest minds will exchange insights, explore emerging trends, and unlock the possibilities for the profession, where foundation will be laid to shape the vision for the future of accounting profession. Hosted at Yashobhoomi, the largest convention and exhibition center in the heart of India's capital, New Delhi, inaugurated by the Honorable Prime Minister Shri Narendra Modi, is all set to host a congregation of accountants from around the world. And while you're here, experience the vibrant culture and heritage of New Delhi, a city where history meets modernity, offering unforgettable memories.
World Forum of Accountants, an experience of 3 days, insightful discussion, groundbreaking innovations, and unparalleled networking opportunities.
With immense pride, we invite you to WOFA 2025, taking place, happening from January 31st to February 2nd, 2025 at the magnificent Yashobhoomi, New Delhi. Experience 3 days of insightful discussions, groundbreaking innovations, and unparalleled networking opportunities. World Forum of Accountants 2025 is where you need to be, where accountability meets innovation, AI for a sustainable planet. Join us at WOFA 2025 from January 31st to February 2nd, 2025 at Yashobhoomi, New Delhi. For more details, visit wofa.icai.org.
It's my pleasure to introduce CA Gayathri ma'am, who is specialized in internal audit and risk assessment and control testing, advisory engagement. I have led internal audit for organizations of various size, private, unlisted, public and listed companies. Lead statutory bank central audit and branch audit for public and private sector bank. Manage concurrent audit for bank at branch level and department level, including international banking. Provided outsourced CFO service for SME in India and US. Thank you, ma'am. I request CA Balasubramanian sir to present memento to our speaker. Hand it over to the speaker.
So today we will start with the session on Basel norms. We would have had several sessions before this on this. So we will be concentrating on the Basel 3 regulations. Even though we had 1 and 2, we will just have a glimpse of what was there in the Basel 1 and Basel 2 and what is different in Basel 3, or what are the improvements which have got in this Basel 3, and then we will dive deep into the capital adequacy requirements which is stated in Basel 3. Yeah. So first we will start with the objectives of the Basel 3. So what were the initially when they started the capital requirements, what was there, and then when it came to Basel 3, what was the objective of this Basel 3 requirements. So mainly it was risk mitigation. So in any of the organizations we see, whether it is banking or otherwise, all the organizations will have some of the risk which they have to mitigate for their survival. Similarly, being banks, they are financial institutions and they are the backbone of any economy. So when a bank is going to fall down, then the whole economy is going to get affected. So it is very pertinent that banks mitigate their risks so that the economy also grows. So the main objective of the Basel 3 was to mitigate the risks, 3 main risks they are stating. One is the credit risk. So we all know that the main purpose of a bank is lending and getting deposits from the customers. So here the credit plays a major role. They are going to give loans to different stakeholders, and they always have this credit risk of NPAs, non-performing assets. And because when they are not able to get back the loans which they have rendered, then again the bank is going to affect it. They are not able to give the depositors back their money. So credit risk is one of the major risk of any financial institution, be it bank or NBFCs or insurance or anything. So credit risk, lending to different borrowers. The risk here is the risk of NPA. So the second risk that is getting mitigated is the market risk. So they have to constantly interact with the market. Their operation doesn't just end with borrowers and depositors. So they have to invest, or they might be facing some interest rate differences. They are hedging. So different transactions with the market. So market risk is also there for them to mitigate. So the financial market is there. So the market risk is how can a bank mitigate the market risk. So that is also addressed over here. Then comes the operational risk. So when we talk about internal controls, like any other organization, in banks also it is very pertinent that they have internal controls. So any risk of frauds or errors or that internal control weakness is going to affect the working of the bank. So by operational risk, we mean the internal control system. A strong internal control system is going to mitigate the operational risk. So there are several other risks, but starting from Basel 1 and Basel 2, Basel 3, these are the major risks that are getting addressed. Apart from mitigating those risks, What is the end result that we get? It is the stability of the financial system. As we already said, the banks are the backbone. So a strong banking system is going to ensure that the economy is stable. So we have heard of so many crises in the past, and we'll be seeing examples of those crises also. So where the banks have fallen down and the economy gets affected, and then ensure Indian banks meet international capital standards. So Basel is not just an Indian standard. It was started, it is from BIS, which we'll be seeing later. So it is an international standard, not just Indian banks are following this. It is globally adopted, so we will have to adopt it. So that is also one of the reasons why we are following this Basel III norms. So Bank for International Settlements, BIS. So they are the central bank for the central banks. So as we have RBI over here, every nation would be having a central bank, and all these central banks are controlled by this central bank, which is called as the Bank for International Settlements. So it is based in Switzerland, Basel. So the norms which they have abide is called Basel norms, and we have also adopted the same, and we call them as Basel norms. So coming to the comparison between or among the different norms. So in different periods of time we have got evolved, and we are now in Basel III. So what is the evolution of these Basel norms? What was there? How did it change? Why did it change? So as we evolve, as we grow, there will be more risks that we have to face. So the regulations also should get updated as the economy grows. So first we see the year of implementation. So 1988 was the first Basel norm which came, and then it got updated. The regulations got updated in 2004, called the Basel II, and then the latest one which we follow now is Basel III, 2010 to 2018. It was phased implementation, so there is a long period of time over there. And then the focus. Initially we focused only on the credit risk. So that was the major task of the bank. So credit risk was the focus initially. So after that they realized that it's not just credit risk, there is so many risks that they have to face. So after that we included market risk and operational risk as well. And then in Basel III we recognized even further risks like the liquidity risk. So if they are going to use short-term funds for long-term, what is going to happen? Their liquidity is going to get affected. So liquidity risk, systemic risk. So systemic institutions are major banks or major financial institutions which affect the working of the economy. So systemic risk is there, forex risk is there, and credit concentration. So as we all know, if a credit is concentrated on one of the sector and the sector is going to not going to perform, then what is going to happen for the economy? So different perspectives and different risks, and the Basel norm is mitigating these. And then the capital requirement. The major objective of Basel is capital adequacy. So what the different versions of the Basel norm say about capital requirement? First, they asked only for 8% of the risk-weighted assets. So we'll be seeing what these risk-weighted assets are. It's just weighted average of all the assets of the bank. So we will be assigning some risk percentage or risk weightage to those assets, and we come out with an average value of those assets. That is what is risk-weighted assets. We call RWA, and it was just 8%. My capital is it is enough if I have 8% of my risk-weighted assets as capital. That was the requirement initially. And then varied by sensitivity. So different phases, different classes of banks were required to have different ratios. And now it is not relevant because in Basel III we have 10.5%. Apart from that, buffer requirements are also there. We call capital buffers are also required. So 10.5% is the current requirement. So the breakup and all we'll be seeing later. And then key features. The main feature was minimum capital requirement. That's all. We were adequate with minimum capital requirement if you follow minimum capital. But in Basel III, we introduced 3 pillars, not just minimum capital, supervisory review, and then market discipline. So supervisory review was relating to internal controls, implementing internal controls, and then a market discipline is disclosure requirements. So even in accounting standards or IFRS, we have more disclosures as it comes. So here also the disclosure requirements of the banks is also abundant. So market discipline is more about disclosure requirements. So we have introduced 3 pillars in Basel II itself. So now in Basel III, what else is there? Strengthening the capital requirement. Already we have capital adequacy requirements. We are strengthening it. We are increasing, like we increased from 8% to 10.5. So we are strengthening it by adding some buffers. And then leverage and liquidity. So new ratios requirements are coming up. Leverage, so how much of debt can be there for a bank, and then the liquidity. What is the liquidity requirement? And then the risk sensitivity. How sensitive are they to the risk? And then focus on systemic risks. That is, we call banks are too big to fail. So if a bank is going to fail, then the economy is going to crash. So we call bank too big to fail. So they are of systemic importance. So we are addressing the systemic risk in Basel III. And then coming to the limitations. These limitations have led to the improvements. So in Basel I, it was not addressing any other risk other than this credit risk. So that was the major limitation. So next in Basel II, it was very complex for a smaller bank to implement because there were so many requirements and they didn't know how it would go. And then relied on external credit rating. So when we talked about this risk weighted average, we are going to assign risk for different assets. So how will I know an asset is going to perform well or not? So it was based on the external credit rating, like any of the credit rating agency would give a rating, and then we used to, if there is a good rating, we used to reduce the risk for it. So how good is it to rely on them? So what if the rating is wrong and the capital requirement is going to crash? So that was one of the limitation in Basel II. Relied heavily on external credit rating for risk weights. And then the financial crisis 2008. So we'll be seeing about that also. So the financial crisis 2008 means that Basel II was not enough. So there was a crisis after that. So we need some more improvements in our financial system. So this led to the evolution of the Basel, and we now have this Basel III. Like, do we have limitations in Basel III as well? That's the question, and we will be seeing it after knowing what Basel III is. If there are limitations, we are going to see that also. Okay, so now coming to risk coverage under Basel III. So we saw that there are several risks that are covered. A few examples are stated here. This is not an exhaustive list. There are so many risks and they are going to mitigate them. So the major risk is credit risk. Right from Basel I, we have been addressing credit risk, and then it still exists. Even after Basel III, every bank is going to face credit risk, but it is just that we are trying to reduce the exposure, that is all. So the 2008 global financial crisis. So how did it happen? What was the reason for this global financial crisis? So it started with this housing loans. So the bank started giving more housing loans to less rated customers. So they don't have good credit ratings, still I go and give it to them at a lower interest rate. So what happened? More people are going to take those loans, and they are not able to repay it because their credit rating is not good. So what will happen? The bank is not getting back their loans, and then the real estate prices are going to fall down. So the economy has crashed. So that was the crux of 2008 global financial crisis. So as we can see, Basel II was already there at that time, but still we had to face this. So what was the issue? How Basel III is mitigating that? After seeing the crisis, we are going to implement something new. So what we have implemented is the stress test, something called as stress test. So how much of risk appetite is there for a particular financial institution or a bank? So that is getting addressed in our Basel III. So implementation of better stress testing. So the banks are required to test themselves as to what is their risk appetite. And then how good are they in absorbing shocks. So that is the mitigation which we are getting in Basel III. And then one more risk is the liquidity risk. So in 2007, what we call as the Northern Rock crisis. So what happened during this crisis? So heavy reliance on short-term borrowings to finance long-term loans. So this is one of the major issue, not only in banks, any other organization which is going to take this risk is going to crash. So heavy reliance on short-term borrowings to finance long-term loans. So this swap is going to reduce my liquidity. So I will not have liquid cash with me. So I will not be able to again repay my depositors. So aggressive lending fuel rapid expansion. So again, every bank is going to do this aggressive lending because they also have some targets. Without considering their strength, they are going to give more and more loans. Then it is going to become a problem. So this liquidity risk was there when Basel II was there. So how we are now mitigating it in Basel III? We have this liquidity coverage ratio. So we have a certain percentage of how much of my assets should I have as liquid asset. So that is going to mitigate my risk of liquidity. And then net stable funding ratio. So how much of stable funds should I have? So I keep getting those funds and it is not getting blocked. So I should have high quality liquid assets and stable funds so that I can meet my short-term requirements. So this is about liquidity risk. And then the market risk. Again, coming back to the 2008 crisis, the market has crashed and the prices are inflating. The borrowers are not able to pay back, and the banks are going to see this problem. So how Basel III has mitigated this? More sophisticated tools. We are going to see those tools, how we calculate the capital adequacy. So new methods. One of it is this internal models approach. There are different approaches, and apart from that we have buffer capital which we have to maintain apart from the regular requirement. So this is how we are mitigating the market risk. And then credit concentration risk. So our credit is getting concentrated in one of the sectors. So previously it was real estate sector. They were expanding and more housing loans were provided. And then when the sector crashed, the banks were facing a problem. And now what Basel III is recommending is we should have a diversity of portfolios, not just one sector. And then how much is the ratio that is required. So to prevent over concentration of loans. Yeah, so as we saw, there are three pillars. This was introduced in Basel II itself, and even now we have these three pillars. Minimum capital requirements. So what is the percentage of capital asset that I should maintain as capital? That is minimum capital requirements. Covers several risks and capital adequacy requirement. And then supervisory review. So addresses each bank's risk profile and internal processes. So it is about, we'll be seeing ICAAP, which is going to strengthen the internal control system of a bank, operational risk basically. And then the market discipline, the disclosure requirements and transparency, public disclosures. So that is the pillar 3, market discipline. Yeah, so we'll go to the scope and scope of applicability of capital adequacy framework. So we have this standalone and consolidated. So we have two balance sheet for a bank. So how should I calculate? The capital adequacy is at both levels. So I should meet the requirement at standalone balance sheet level also and the consolidated level also. After consolidating, whatever is required as per the standards, accounting standards, we have the holding company, subsidiaries, the joint ventures, associates, whatever I'm going to consolidate, I have to add everything and then calculate the capital adequacy. So here some exceptions are mentioned, except those in insurance and non-finance activities. If any of my subsidiary is going to be in insurance or any non-finance activity, then I will not take that. Apart from that, all the subsidiaries I am going to consolidate and check whether I am meeting those standards. And then the standalone level also I should be able to meet those standards. So comply at both levels, includes overseas branches, operations in both the cases. So if I have some overseas branch, then I should consider that also, because I have loans there. I should consider that also as my assets. So this is the scope. And then coming to elements of regulatory capital. So here comes the major calculations which we are going to do for the capital adequacy requirement. We have something called Tier 1 capital and Tier 2 capital. So Tier 1 capital is the going concern capital. So this capital is required for me to be a going concern. So that is what is going concern capital. I should be able to continue my operations, and if I am going to face some losses, because of this capital, I should be able to absorb the losses and continue. That is what is this going concern. So even during losses, because of this capital, I should be able to continue my operations even after absorbing those losses. This is Tier 1. Tier 2 is the opposite. Gone concern. It is called as the gone concern capital. That is, I will be able to absorb my losses, but I cannot continue my operations. So that is the Tier 2 capital. So Tier 1 capital, again there are two parts in the Tier 1 capital. One is this common equity Tier 1 capital, and then additional is there. Now we will see this common equity Tier 1 capital, which is a part of Tier 1 capital. So paid up equity capital, and then share premium on issue of equity capital, and then all my statutory reserves, capital reserves, other disclosed free reserves, that is available for dividend distribution, other disclosed free reserves, and then balance in P&L at the end of the previous financial year, and current year, what is the profit I can take. That is net profit up to this is calculated quarterly. The capital adequacy requirement is quarterly requirement. So up to the quarter, where I am reporting, up to the quarter, and 25% of the average of the previous 3 dividends. I have to reduce that from the net profit. So that will be the eligible profit that I can consider consider it as common equity Tier 1 capital. So if we see our balance sheet, the most of the starting whatever is there, that is all covered in this common equity Tier 1 capital, which is a part of Tier 1 capital. And then additional capital. So as I told, there are two types in this Tier 1. One is common equity Tier 1 and additional. So this is the second part, that is additional capital. Perpetual non-cumulative preferences. So perpetual is I am not going to repay now. It is only going to be at the end. And non-cumulative. My dividend is not cumulative. If I don't repay now, I need not repay. I need not pay my dividend next time. So this is non-cumulative. This is almost like an equity only, because it is perpetual and it is non-cumulative. But a preference share, not equity share. So perpetual non-cumulative preference shares. And premium. When I issued, what was the securities premium I have got? Premium on perpetual non-cumulative preference shares. So this will be included in my additional capital. So together they make the tier 1 capital. So the common equity tier 1 capital and then this additional capital together make tier 1 capital. So this is the first part. Then coming to the second one, tier 2 capital, which is called as the gone concern capital. Absorb losses during winding up. So I can absorb my losses but I cannot continue my operations. So here we have general provision and loss reserves. Whatever we saw, apart from that, what is there in the reserves. So general provision on standard assets, excess provision on sale of NPA, investment reserves, debt capital instruments. So we didn't have debt over there, here we are having debt. Debt capital instruments, it's a debt but it is a capital instrument. And then preference shares, other kinds of preference shares. There we saw perpetual non-cumulative. Here we are seeing perpetual cumulative. So even though it is perpetual, my dividend is cumulative. So it has a debt feature in it. Perpetual cumulative preference share, redeemable non-cumulative preference share. So even though it is non-cumulative, it is redeemable. So that is one debt feature in this. And then redeemable cumulative. So this is purely debt feature. Redeemable and it is cumulative, but it is a preference share. And then premium on issue of all of the above types of preference shares. So all this will be included in tier 2 capital. And then adjustments and reductions. So I have added all these, tier 1, tier 2, additional everything. So what should I reduce from this? Adjustments and reductions. Goodwill and other intangible assets net of deferred tax liabilities. So why should I reduce this? This capital is basically assets minus liabilities. So when we calculate capital, what we are trying to tell is asset minus liabilities. But we are going to reduce this goodwill from the asset because we don't have anything that we can receive out of it. So we are going to receive deduct the goodwill and any other intangible assets, and we have recognized any detail deferred tax liability on that. We are not going to consider that. It is net of that. Assets net of DTL if any. And then operating losses in current year or brought forward and their associated deferred tax assets. So that also it is not realizable. So we are excluding that deletions. And then cash flow hedge reserve. Any hedging the bank has carried out, that reserve which they are maintaining, that is going to, any profit they have received due to cash flow hedge, that is going to be there in cash flow hedge reserve. That also we are going to remove. And then gain on sale related to securitization. So banks actively take the securitization. They are going to securitize their assets and get the assets trans. So any gain on that will be excluded. And then defined benefit pension fund. So for the employees, whatever defined benefit plans they have and the asset they have created, that asset will not form part of the capital. Investment in own shares, that is also going to be excluded. And then investment in banking, insurance or financial institution. So that is also going to be excluded. So we are going to calculate all the capital and then reduce anything. If anything is there, we have to reduce. So this is the adjustment and reductions. Next. Criteria for classification as common shares. So we saw what are all the equity shares. So again there is one criteria, only if they are going to meet this criteria I will consider them as capital, otherwise I should not add them. So what are those? They should have voting shares, they should have some voting rights. So if I don't give the voting rights, barring the voting rights, everything else should be similar to a share with voting rights. So who will have this voting rights? Mainly equity will be having. So even if I don't have that feature, all other features should be there apart from voting rights. So only then it is considered as an equity share capital and I can include in my capital computation. And then subordinated claim, ranks lower than other claim. So when I'm going to liquidate, I will have priorities in paying back. So this is the most subordinate, that is, this is the least one. So first what I will pay, least what I will repay. So generally equity share we are going to be paying only at the last. So this should be the one which is the subordinate, lowest in other claims when compared to other claims. And then unlimited or variable claim on liquidation. So these are all typical features of an equity capital. In debt we don't have all these features, so that is what is the intention. Unlimited or variable claim on liquidation, we know equity has this feature. And then claim on residual assets proportionate to paid up capital. So only proportionate to the paid up capital they will be able to claim. And then perpetual principal. So in the middle I cannot repay an equity capital, so this is what is perpetual principal, not repay except on liquidation. But if there is a buyback I can repay, that is not an issue, but otherwise it is perpetual. And then distributions made on distributable profit. So dividend typically we pay only out of distributable profit and non-obligatory. So dividend is non-obligatory. Classified as equity capital on insolvency and classified as equity capital by accounting standards. So that is also one of the requirement. Neither secured nor guaranteed. So we have seen all the features, these are typical features of our equity capital. So all these requirements should be met, only then I can classify, I can take as a capital for my computation. Now we are going to see the breakup of that percentage. So we saw tier 1, tier 2, additional, everything. So now what is the individual requirement? Regulatory capital as a percentage of risk-weighted assets. So we are now going to see the numerator of the calculation. Denominator is the risk-weighted asset, numerator is the capital. So what is this capital? Minimum common equity tier 1 ratio. So as we saw, first the tier 1 is there. In tier 1 we are having common equity tier 1. This is that one, common equity tier 1, where we saw the equity, share premiums, reserves, everything. All those are considered here. Minimum common equity tier 1, CET1. It is called CET1. Common equity tier 1 ratio is 5.5% of risk weighted asset. This is the minimum requirement. And then there is something newly added in Basel 3, which is the capital conservation buffer. So apart from this 5.5, I am giving further buffer of 2.5%. So this is also, this buffer should also be kept out of common equity tier 1. The capital from common equity tier 1, apart from 5.5, extra buffer of 2.5%. So how much of common equity tier 1 I should have? Totally 7 I should have. Previously 5.5 was there. Now new name is given, capital conservation buffer 2.5. So totally 7% out of common equity tier 1 I should be having. And then additional tier 1. So we saw this perpetual non-cumulative preference share and their share premium. So additional tier 1 capital I can have 1.5%. So when we calculate the total, we don't take the capital conservation buffer. So removing the capital conservation buffer, it will be 5.5 plus 1.5, that is 7%. 7% I should have minimum as tier 1. So we saw tier 1 two types, common equity tier 1 plus additional. So common equity tier 1 plus additional is 5.5 plus 1.5, totally 7%. So minimum I should have 7% as tier 1 capital on my risk weighted assets. So this is the minimum requirement of 7%. So if I have only 7% and I have common equity tier 1 as 5, assuming I have 5 and additional tier 1 as 2, totally 7. So there will be a question, is that possible? So total tier 1 I should have 7. 5.5 plus 1.5, 7. Can I interchange 5 and 2, 4 and 3? Is that possible? So next we will have this question, that is not possible. 5.5 is the minimum and 7 is the minimum. So 1.5 is the maximum. So if I have 7, then 1.5 is the maximum additional tier 1. Right, that is only possible. If I have only 7%, then our maximum additional tier 1 capital can only be 1.5, because 5.5 is the minimum requirement. 5.5 is minimum capital equity tier 1 is minimum and total is minimum. So additional can be maximum 1.5. What they intend to say is 5.5 is minimum. I cannot adjust between common equity tier 1 and additional. So I have to minimum meet capital equity tier 1. Additional, in name itself it is there, additional. It is only additional. I cannot compensate the loss of there with additional. So additional 1.5%. If more than 7 I am having in tier 1, then I can increase additional. Yeah, so that is about tier 1 capital, 7%. Then I am coming to tier 2 capital, 2%. So we saw those with some debt features. We saw some examples. That is in tier 2 capital, which is minimum of 2%. So we are going to calculate again total. 7 plus 2. 7 tier 1, 2 tier 2 and 9. Again here I cannot swap between tier 1 and tier 2. Tier 1 is stated as 7% minimum. Total is stated as 9% minimum. So tier 2, they will, in the regulations, tier 2 minimum is not stated. Tier 2 minimum 2, it is not stated. That is the corollary. 2% is the maximum. If I have only 9, then maximum 2% only I can, it is possible to have tier 2. Because 7 tier 1 is minimum. Minimum tier 1 7%, total capital minimum 9%. So the difference is 2% only I can have in tier 2. If I increase my total to 10, then I can have 3 in my tier 2. That I can increase. But the minimum requirement should be met. So minimum total capital ratio is 9%. If I include the capital conservation buffer, it will be 11.5%. Including the buffer of 2.5%, it is going to be 11.5%. Yeah, so this is the computation which we have seen. And then the composition of the capital. So tier 1 capital, we already saw this. Common equity tier 1 plus additional, and what are all the components of it we have seen. Common share, statutory reserves, P&L we have seen. Tier 2 capital, mostly debt instruments and revaluation reserve. So this is in summary, the composition of capital. So now we are going to calculate the ratio. This is common equity tier 1 capital ratio. These are all the 3 ratios which they are telling. So they will not tell ratio for additional, they are not telling ratio for tier 2. So this is the minimum requirement. Additional is always additional, tier 2 is always additional. Even if I don't have tier 2, that is not a problem. But I should have tier 1. Assuming here if we see tier 1 7 is required, total 9 is required. So if I have tier 1 itself, if I have 9, then that is not a problem, because tier 2 is not mandatory, that is only additional. Similarly, additional is also additional, so that is not a mandatory one. So if I fulfill that itself, minimum common equity itself I have 7, then I need not have this additional, because total 7 is met. So only these ratios are mandatory. Common equity tier 1 capital ratio which is required to be 5.5%. Common equity tier 1 capital divided by risk weighted assets. So numerator we have seen, denominator we will see the calculation. Common equity tier 1 capital, whatever I have calculated, adding all those capital, premium and all, divided by risk weighted average. And then tier 1 capital, that is tier 1 plus additional if any, I will add both, divided by risk weighted average assets. So this is the tier 1, 7% minimum should be there, other than buffer. Other than buffer I should have 7%. And then capital to risk weighted, this is total. Total I should have 9%. 7 plus 2, 9. Total I should be having 9% apart from buffers. Capital to risk weighted as CRIR, capital to risk weighted assets ratio, eligible total capital, including my common equity tier 1, additional tier 2, everything put together, I should have 9%, eligible total capital divided by risk weighted assets. So these are the mandatory requirements. Apart from this, I should have a buffer of 2.5%. Now, we have this capital charge for credit risk, capital charge for credit risk, standardized approach. So this is capital charge is nothing but the risk weights which we are going to give for every asset. We saw the ratio calculation, the denominator is this one. So when it comes to risk weighted average, by risk weighted average we mean 3 risks: credit risk, operational risk and then market risk. So for risk weighted is divided into 3 risks again, risk weighted average. First is this one, capital charge for credit risk. So credit risk, what is the risk, how I am going to calculate risk weighted average. So we are going to see some examples and look at what is the risk weight the regulation is giving us. First asset category is cash and sovereign exposures. So in cash I cannot give any risk because it is already there in my hand. So I am giving 0 risk. So fully it is there for me. I don't have any risk for that. Cash, government bonds, this is AAA rated. And then claims on central banks and foreign sovereigns. So with this we have 0%. When it comes to government bonds, we don't have any risk. So that is 0. But when it comes to foreign sovereigns, it depends on the rating. Rating they are giving Moody and SP. So if they are going to give a high rate, I have a low risk. If they give a low rate, then I have a high risk, which I should attach to it. So capital and sovereign bonds. And then bank exposures, interbank loans, claims on other financial institutions. So 20% to 150% risk weightage based on the credit rating they have. The counterparty is having. I am going to assign risk. Again, if there is a good rating, I will have low risk. If there is a very bad rating, then I will have a high risk. And then corporate exposures. Whatever corporate loans I am going to give, and bonds issued, whether it is a loan or as a bond. 100% for unrated corporates. If it is unrated, I will give a weight of 100% risk. If it is a rated one, again depending on the rating, I am going to vary the risk. And then retail exposures. Other than corporate, I might be giving some vehicle loans or housing loans. That is coming under retail exposure. Consumer loans and then credit cards given, and any small business loans, any sole proprietors are there, then the small business loans. So it is 75%. Reflecting lower default correlation. So 75% is the risk weight I am going to give for a retail loan. And then equity exposures. So equity investment in my subsidiaries and publicly traded equities. So 100% to 400% depending on the type of equity. So we don't have any confidence in that, because so we are giving 100% to 400% depending on the type of equity. And then real estate exposures. So residential mortgages and commercial property loans I have given. That is 35% for residential mortgages and 100% for commercial loans. So that is the risk weight I am going to assign. And then securitization exposures. 20% to 1,250% based on the tranche seniority and rating. So mortgage backed securities and assets backed securities. These are basically the securitization exposures I have. This is the rating, because when I go for securitization, it is already an NPA. That's why I am going for a securitization. I have taken a securitization of these assets. So I am giving a more risk rating for this. And then non-performing asset, it is already not performing. So there is more weight, risk weight for this. 150% minimum we will give risk weight. And then off balance sheet exposures, loan commitments, these are off balance sheet. Still we are going to give assign a risk for that. Derivatives and guarantees, which is going to be my commitment. This is only my commitment. But still we are going to give based on the credit conversion factors. So this is the risk exposure, some of the risk exposures which we are going to assign while calculating my minimum capital requirements. So this is only for the capital risk, credit risk. In the three risks, this is for the credit risk. And then coming to the capital charge for operational risk. Here, there we use the standard approach. Here we are going to use the basic indicator approach. This is basically the calculation method. So we are assigning 15%. 15% of average gross income wherever positive for the previous 3 years. So I am going to take the gross income for previous 3 years only if it is positive. If it is negative, I am not going to consider. So for example, in 2 years it was positive, 1 year is negative. I will take average of only 2. Both the years divided by 2. That is the calculation. If it is positive, I am going to take for the previous 3 years in that 15%. That is the charge, that is risk weight for the operational risk. In taking operational risk, this will be my risk weight. So what is this gross income? So gross income means net interest income and net non-interest income. Both we have to consider, interest income, and if any non-interest income is there for the bank, that also we have to consider. Gross of provisions and write-off. Gross means we should not deduct. Net means we should deduct. Gross means we should not deduct. We should not reduce any provision, or we should not reduce any write-off. It should be added, or it should not be deducted. It should not be, gross means it should not be deducted. Gross of provisions and write-off. Gross of operational expenses. This is something like the gross profit which you are going to calculate. So it will have only direct expenses will be deducted. Similarly, operational expenses, indirect, will not be deducted. It is gross of operational expense. We should not deduct that. Excludes reversals during the above. So anything reversal is there. Reversal of provision, reversal of write-off, or reversal of operational expenses, that should be excluded. So opposite of this, I should not deduct provisions and write-off, but I should consider reversal. If there is any consider, I should deduct. I should not consider those reversals. It is the opposite. Exclude reversal during the year. So in any previous year I had done that. Now I am going to reverse. And then exclude income from disposal of movable and immovable properties or securities held to maturity. I am going to dispose some immovable property or any securities, then that should not be considered as my gross income. So mainly operation, they are meaning operational income. We can just imagine our cash flow statement. This will come somewhere in investment. So we are not going to consider these. We are going to assume it as just operational. Excludes income from legal settlements, extraordinary, irregular and insurance activities. This is also some extraordinary, so we are not going to add those. Only relating to operational income we are going to take. Again, average of last 3 years multiplied by 15%. So that is how I calculate my risk weighted average of operational risk weighted average asset. And then coming to capital charge for market risk, standardized duration approach. So coming to market risk weighted average calculation. Risk weights and factors based on size and complexity of the bank. So we are going to, again here in market risk there are 4 types which we are giving. Interest rate risk, because it is dependent on the market, equity risk, forex risk and commodity risk. All these risks are a part of market risk. So giving this is something variable which is not specified. So it is going to differ from bank to bank, and then I am going to assign specified percentages of risk for all these factors, and I will arrive at the market risk weighted average calculation. Again, coming to the buffers. There are 2 buffers which I have to maintain as per the regulation. Capital conservation buffer and then counter-cyclical capital buffers. So there are 2 buffers which I have to maintain. We already saw this capital conservation buffer. Minimum requirement is 2.5% of risk weighted average of assets. Why should we maintain this? This is to absorb losses during financial stress. So I should be able to continue my operations and absorb the financial stress. So I am going to maintain this capital conservation buffer, 2.5% of the risk weighted assets. Again, this is out of the common equity. We already saw this capital conservation buffer. Common equity tier 1. As part of common equity tier 1, 5.5%. Additionally, I am going to maintain this capital conservation buffer above the 9% requirement. Should not distribute profits when level falls below this, but they can operate. Assuming my capital, I am not able to cope up with this requirement of capital conservation buffer. So what will happen? Should I shut down my operations? That is not required. So, but the minimum requirement is there, 9%, that is there for minimum. This 2.5%, if I am not able to maintain, I should not distribute dividends. I should try to bring it up. I cannot distribute dividend, but I can continue my operation. So 9% is mandatory. Buffer is does not affect my operation, but I should mitigate that and bring up my capital. This is about capital conservation buffer. And then counter-cyclical capital buffer. So this is depending on the bank and depending on the regulator's requirement, it could range from 0 to 2.5%. So if a bank is not going to have counter-cyclical capital buffer, then it is not an issue, because it can range from 0 to 2.5% depending on the bank and the regulator's requirement. So if required, there is a provision in our regulation. So if required, they can impose this as well. So this is to mitigate the risk by adding capital during growth. So if you are going to perform well, I am going to add my capital. During stress, I can withdraw and absorb my losses with that capital. So during good performance, I will use it and withdraw during requirements. So it ranges from 0 to 2.5% of risk weighted assets depending on the assessment by the regulator. And then domestic systemically important banks. So we saw the systemic risk because we call a bank as a too big to fail, because they are going to affect my operation of the economy itself. So a bank cannot fail it. So it doesn't have the luxury to fail or get liquidated. So they are called domestic systemically important. And some banks are given this as domestic systemically important, big banks. So for them, they are having additional capital requirement apart from the buffer 11.5%. Again, they should have, if they are a systemically important bank, they should have additional tier 1 capital from 0.2% to 0.8%, based on the complexity of operation of that bank and on their systemic importance. As they are more important, more will be the ratio requirement. This is for a systemically important bank. And then leverage ratio requirements. Again, the regulation on Basel 3 is talking about leverage. So leverage is nothing but the debt. So I cannot have more of debt and less of capital. That is going to affect it. So we are specifying what is the leverage ratio which a bank should have. So this is to restrict banks from excess leverage, that is excess debts. How do we calculate this leverage ratio? This is calculated based on tier 1 capital and total consolidated asset. Total maximum leverage that I can have, maximum debt I can take. So why do we have this leverage ratio? Serves as a backstop to risk-based capital assets. So my capital assets are protected. So if I have less of debts, then it is going to be easy for me. The leverage ratio shall not fall below 4.5%. So I am going to capital based on my tier 1 capital and total consolidated assets. This ratio cannot fall below 4.5%. So it means that minimum for 4.5% of my asset should be capital. So if it is going to fall below 4.5, it means that I am having my asset is more of debt. So if we reduce from say 100, so we'll be having 94.5. So 95.5. So 95.5 is the maximum. 4.5 is the minimum, means 95.5 is the maximum for debt. Minimum 4.5 for capital means maximum 95.5 only I can have for debt. If I am going to have more of debt, more than 95.5% of my asset is my debt, means then I cannot survive. So then coming to liquidity coverage ratio. This is another ratio. Apart from the leverage, we are talking about the liquidity coverage ratio. 100% should be there. Minimum 100%. Ensure banks have sufficient high quality liquid assets to withstand a 30-day period of liquidity stress. So I should be able to withstand, if even for 30 days I have a stress, then still I should survive. So with this I will be able to survive. The regulation says liquidity coverage ratio 100%. So how do I calculate this? High quality liquid assets divided by net cash outflow over 30 days. So I am going to calculate what would be my average outflow for 30 days. What could be my outflow? There are some depositors who are asking, or there is some obligation which I should be paying. So what is my average outflow? What I should be paying and what I have? It should be the same. 100% means both should be same. High quality liquid asset divided by net cash outflow. I am going to forecast for the next month what is going to be my outflow. So today I should have that much of liquid asset as cash or cash equivalent. I should be having that much of cash with me. Net stable funding ratio. So this is also required as 100%. So minimum net stable funding ratio is set as 100% to promote long-term financial stability. Stable funding is required for 1 year. So that I should have stable funds so that I am able to sustain for 1 year. So for the next 1 year, I am going to forecast what will be my requirements, short-term requirements. 1 year means it is going to be short-term. So short-term requirements, and do I have funds to meet? The previous one was about liquidity. This one is about my funds. So do I have funds to meet the short-term requirements of next year? So 100% I should be having today. So this is about net stable funding ratio. So as we saw in the beginning, we were having 3 pillars in the Basel. The first one was the minimum capital requirement. Second one was about this supervisory review and evaluation process. So I am going to review the process, or I am going to review the internal controls which I have, and the RBI is going to impose some supervisory review requirements for my bank, and they are going to evaluate how I work. That is supervisory review and evaluation process. Internal capital adequacy assessment approach. This is about ICAAP, internal capital adequacy assessment process. So I am going to assess myself whether I have the internal capital adequacy, whether I am meeting my internal capital adequacy. So I should be able to forecast. So what is going to be my risk profile in the coming years? So will I be able to meet the capital requirements in the coming years? So I should be able to assess now itself. So that is about this internal capital adequacy assessment process. And then stress testing. So this is one of the feature of Basel III, which is talking about stress testing. So this is also a voluntary one. I should assess my own bank, what is the stress I have, and whether I will be able to absorb those, whether I have the risk appetite to absorb the stress I am going to face. So understand potential vulnerabilities and take preventive measures. So this internal process, the supervisory review, is more about a forecast. So in the minimum capital requirement, that is about the existing capital which I have. This is whether I will be able to meet the requirements in the future. So if not, I have to take corrective action and preventive action now itself. So this is about the stress testing. So RBI is going to conduct a supervisory review of all the banks, their internal risk management practices, and their capital adequacy in relation to the risk. So this supervisory review of the internal controls in place of a bank is going to be conducted by the RBI. Address risks beyond pillar 1. So this, in pillar 1, what are all the risks that we address? The pillar 2 of the internal control supervisory review is going to address few more risks. That is the credit concentration risk. Because when I calculate a minimum capital requirement, I don't see any credit concentration. It is all on a total basis. So we don't go into the details. So here I should be able to assess. So when I am going to assess the vulnerabilities, this is one of the consideration that I should have. Credit concentration, reputational risk. So what reputational risk I could face? So a bank should be able to forecast that and mitigate it. Strategic risk, any strategic decisions on new loans that is going to be given, or any new models that they are going to take. Strategic risk, again model risks. Risk of securitization. So whether it is good to accept securitization or to give securitization. Poor portfolio risk management. So this risk is going to get mitigated in supervisory review. So am I able to manage the portfolio risk? Lack of attention to changes in economic circumstances. So this is more than a financial figure. So do I keep an eye on the economic circumstances and act accordingly? So that risk is getting mitigated by this supervisory review and evaluation process. Yeah. Coming to the 4 principles of risk assessment. The asset capital adequacy in relation to risk profile. So I have to assess whether I have the capital adequacy first, that is the requirement. Today and tomorrow. Tomorrow will I be able to meet the standards? And I should be able to sustain that. And the supervisors of a bank, they should review and evaluate the capital adequacy. That is constantly, that should happen. Any day it could fall. So on a constant basis, they are going to review and evaluate the capital adequacy. Supervisors to require banks to hold capital more than minimum level. So 11.5%, it is not enough. Again, we are going to have more capital. So that is only the minimum requirement. If I am a bank which faces a lot of risk, if as I grow bigger, I am going to face a lot of risk. So again, as I grow in size, as I grow in risk, I should have even more capital. So more than the minimum, supervisors require banks to hold capital more than the minimum level. Prevent capital from falling or require rapid remedial action. So I should increase and not decrease. That will be the objective. So what I should ensure at the end, so in crux what this capital requirement is saying, higher the risk, higher the capital. So that is what is the moral of the story. Higher the risk, higher the capital. Capital can be reduced only if risk is mitigated or reduced. So otherwise I don't have the cushion to reduce my capital. And then comes the third pillar, which is disclosure requirements. Market discipline is stating about the disclosure requirements, how transparent I am, how much of the more the disclosure I give, more I am transparent. So the integrity is shown in the disclosures. To improve transparency and the quality of information provided by banks to regulators and the public. Mandated banks disclosure key information on their capital adequacy, risk exposures, liquidity, risk management practices. So all these are mandatory disclosure for a bank, whether they meet the capital adequacy. So we had some calculations. We will be seeing some examples of 2 banks, how they are disclosing. So they have to calculate and prove that they are meeting the minimum capital requirement standards. That is one of the disclosure requirement. Risk exposure. So what are all the risk? More than financial figures, they are going to talk all this risk exposures that they have, whether they are meeting the liquidity standards. So we had this liquidity coverage ratio. So they have to calculate and show whether they are meeting those standards. And the risk management practices. So what are all the best management practices that they have to mitigate the risk? These are all the quarterly disclosure requirements. So I should be checking my whether my capital is adequate. Every quarter I should be checking. Quarterly disclosures on the Tier 1 capital, common equity Tier 1, total capital, liquidity coverage ratio and net stable fund ratio. And then other disclosures. Securitization exposure in trading book and valuation. So apart from these disclosures, they have to talk specifically about the securitization process. What is the exposure in securitization and the valuation. And then sponsorship of off-balance sheet vehicles. So any other investment vehicles or loan vehicles that they might have, which is off-balance sheet, which they are not going to give in the balance sheet. In the disclosure, they are going to specify what are all the off-balance sheet vehicles that they have. And then in the previous slides in the starting, we were seeing about the limitations of Basel 1 and Basel 2. So Basel 1, we saw that it is mitigating only the credit risk. So others are not. The second one, we saw that small banks could not cope up with it, and it was very complex in implementing for them. And again, only 3 risks were mitigated in that. So Basel 3, we cannot tell that it is also taking care of everything. So we might expect Basel 4 in coming years because of these limitations. Limitations of Basel 3, we see that it was a phased rollout. Sorry, this is actually 2018. 2013 to 2018. So there was a full delay in its impact. So the impact I was expecting, it was lasting for 5 years. The banks were implementing in a phased manner. So I couldn't see the results of it due to this phased implementation. Others were implemented in just 1 year. But here I had a phased implementation. That was for ease of the banks, but that itself became a limitation as well. Complex for small banks. Again, this is always going to be there. How is a small bank going to constantly evaluate? How are they going to mitigate all the risks? How are they going to follow all the internal process and internal control requirements? So it is complex for a small bank. Requires significant resources for risk assessment, reporting and technology upgrades. So how are they going to cope up with it? That's a question. Focuses on larger banks, leaving loopholes for small banks and NBFCs. So this is mainly for the systemically important banks. So these requirements, what will an NBFC do? So what will other small financial institutions do? So there are loopholes in that also. Non-banking entities such as hedge funds and private equity are not adequately mitigated. We are not going to address them. So they are also financial institutions. They are also performing like banks, but we are not mitigating the risk of them. So should we expand the requirements to them also? So that should be considered in future. And then liquidity coverage ratio. So we are giving coverage only for 30 days. So on 31st day, what will happen to the bank? 30 days I survive, and 31st day I cannot survive. So is that the objective? That's the question. And because a crisis will not end by 30 days, I cannot tell crisis will be for only 30 days. Requires sophisticated modeling and subjective judgment for calculating RWA. So risk-weighted asset, this was a limitation Basel 2 itself. So risk-weighted asset is a subjective one. So they are only going to give a range. They are telling 20% to 1,250%. So this range is so big and it is very subjective. So I will argue that my risk is low. So again, this is going to create a problem. So this is subjective judgment. Again, we are still depending on the credit rating agencies for some of the risks. So this is not fully mitigated. And then higher capital requirements may lead to reduced lending, potentially stifling economic growth. So I'm going to impose more and more regulations on a bank that they cannot do their operations and they should only keep complying with their requirements. So the real objective of a bank is going to get affected. So one side I will be posing more of regulations. So that is what is told here. And then cost of complaints passed on to the customer. So this is always there. So whatever internal processes and more sophisticated process, it is increasing the cost of a bank, and ultimately it is inflation. It is leading to inflation. Again, the customer is going to get affected because of that. Then it is going to be a vicious cycle again. Manipulation of RWA. So as we saw before, it is very subjective. The percentage is very subjective. So I can easily manipulate and show that I have required capital, even if I don't have. Relies on timely and accurate data, which is challenging during real-time economic stress. So every quarter I should be able to update it. Today the credit risk will be something, and tomorrow if the customer is going to collapse, then their credit rating is going to get affected. So on a real-time basis, this is going to change. So today I have all performing asset, tomorrow it becomes a non-performing, and my capital is going to go down. So it's a very dynamic calculation. So it depends on the real-time situations. So it is not going to be static. So every time I should be very agile in meeting the requirements. Relies on timely and accurate data, which is challenging during the real-time economic stress. And to get that data also, that is it is going to be a bit difficult. So what is the rating of them? So actual data, to get the actual data, that is, and real-time data on a timely basis, that is going to be a limitation. So majorly these will be the Basel III limitations. So we will be seeing some examples of how banks are disclosing for all the three pillars. And then they are telling that the market discipline, that is the market discipline is about the disclosures. So they are telling that all the disclosures as required by the regulations they have made, capital adequacy and risk management framework of the bank. So this document covers the pillar 3 disclosure and capital adequacy status of IDFC First Bank. In disclosure itself, capital adequacy is going to get covered. And then the risk process and governance at the bank for efficiency on board and monitor the report risk. So first they are giving two types of disclosures, the qualitative disclosure and the quantitative disclosure. So as we saw, the capital adequacy is required both at consolidated and standalone level. So that is what they are mentioning, group entities covered for consolidation. So as per AS 23, whatever methods they have using, and AS 21 they are using for consolidation. So they are telling about who are all their subsidiaries. Even if it is outside India, we have to branches, we have to take them into consideration. So whether they have included for their capital computation, that is mentioned over here. And method of consolidation, AS 21, AS 23 for associates. Not considered for consolidation, not applicable. So they have consolidated everything. And then comes the quantitative disclosures. So they are telling about their total balance sheet size, the equity and assets. Any capital deficiencies? No. And then the aggregate book value. Does not have any investment in insurance entity. So if that is there, that should have been excluded. So they are not having it. And then the disclosure, second disclosure is about the capital adequacy, qualitative disclosures. So how they have calculated, the method of calculation they are telling. So there are several methods, but the regulation is recommending only specified methods, which we saw in our presentation, that these are those methods. For credit risk, we are taking the standardized approach, and then market risk also we are taking the standardized approach, but for operational risk we are using basic indicator approach, the 15% of gross assets, that is the operational risk. In addition to it, they are having internal capital adequacy assessment process for the second pillar, supervisory review. So they are stating under the second pillar they have to review what are all the risks they are facing. So that is the disclosure which they are giving here. Interest rate risk, credit concentration risk, liquidity risk, settlement risk, reputation risk, business and strategic risk, risk of underestimation of credit risk under the standardized approach, and then model risk, risk of weakness in credit risk mitigants. So that is one risk. Risk of weakness in credit risk. If there is any risk in mitigation, that is again one risk. So that they are again mitigating. So information technology risk, information and cyber security risk, securitization risk, pension obligation risk, currency induced credit risk, outsourcing risk, compliance risk, business continuity management risk, and the list goes on. People risk, conduct risk, climate risk, fraud risk, pandemic risk. So there are so many risks they are stating, and it seems they are mitigating all those. And they are telling that they are a strong capital and liquidity position. The ICAI serves as a key guiding tool towards capital management. And their ICAI is still evolving. So it is not a static one. Every time they are improving it. It is subject to regular and independent review by internal audit department. Because it is required under supervisory review and evaluation process. The internal controls are required under this. So areas of review. In supervisory review, what are all they are doing? Integrity, accuracy and reasonableness of the processes. Appropriateness of the bank's capital assessment process based on nature, scope, scale and complexity. Timely identification, accuracy and completeness of data. Reasonableness and validity of any of the assumptions. And conduct appropriate stress testing. So this is under Pillar 2 requirement that they are following. So what stress testing they do? How do they do it? Sensitivity test envisaged by the bank. Stress testing framework demonstrate how stress testing is used to evaluate the impact of various stress situations. Okay, they have a policy. The board approved stress testing policy in line with RBI guidelines. So what do they do in stress testing? Banks risk exposure under stressed conditions, improve understanding of the bank's risk profile and material risk, evaluate their capacity to withstand stress situation, enable appropriate strategies for mitigating significant risk. So this is their stress testing, what they do. And then the quantitative disclosures. So now comes the numbers. So by Basel 3, minimum regulatory capital to risk weighted assets ratio to be maintained by the bank is 9%, 11.5% including capital conservation buffer. And minimum common equity tier 1 is 5.5%. It will be 8% if I include CCP. So they are stating that minimum requirements and then they are giving the numbers in crores, capital requirements for credit risk. So how much of capital should I have? So they are calculating and they are giving it as 22,713 crores. So for market risk I should have 775 crores and capital for operational risk I should have 1,915 crores based on basic indicator approach. And then they are calculating on standalone and consolidated basis. So credit risk on balance sheet items, non-market related off balance sheet, exposure to QCC. And then risk weighted assets for market risk, interest rate risk, equity risk and foreign exchange risk. And then they are calculating what is their tier 1 capital, tier 2 capital and arriving at the percentages. So they are having 13.36 which is well above the requirement both at consolidated and standalone level. And tier 1, so if we see they have CET1 and tier 1 are same. So they don't have any additional capital. So they are meeting the minimum requirement with CET1 itself. And CRAR they have 16.11 which means that they have some tier 2 capital. So risk exposure and assessment. So we saw there are 4 principles in this risk assessment and they are stating all those. It is risk taken is approved by the risk management framework. It is we have a defined risk appetite. We are adequately compensated for the risk and we are continuously monitoring and managing our risks. So risk management team. So how they are managing the risk. The board of directors Then they have MD and CEO, Chief Risk Officer is appointed, and below them he is having wholesale risk. Different segments they are mitigating. Head wholesale risk, head market and retail banking risk, Chief Information Security Officer for the systems, head enterprise risk, and head portfolio analytics and regulatory reporting. So they are having 5 persons who are responsible for monitoring their risk. Risk infrastructure, their policies and procedures. So they are defining their risk appetite and the risk parameters. So they are defining both and they are mitigating that. So what is the governance procedure? Chief Risk Officer is managing execution of the risk governance framework. So they have a robust risk governance framework based on the following key principles. So the board is responsible for overall governance and oversight of core risk management. After him, they are having segregation of duties in 3 lines of defense model, which we saw. In front office functions, risk management and oversight. The risk manual is already approved by the board, and they on an annual basis they are reviewing it to align with the risk, capital and performance targets. So they are managing process, credit risk, management risk, operational risk, liquidity risk, business risk, reputational and other pillar 2 risks are mitigated. They have policies, process and systems in place, appropriate representation on management committees and stress testing and escalation tools. So who are their governance committee? So under board of directors, risk management committee of the board, credit and management risk management committee, market risk management committee, asset liability management committee, operational risk management committee, information securities committee. And then credit and market risk committee. So what are they doing? Overseeing implementation of credit risk management framework and market risk management framework across the bank. So they are required to make so much of disclosures and ratings. So that is what is there in the market discipline. So this is called as the market discipline. So what does the asset liability management committee do? So they are decision making unit responsible for integrated balance sheet risk management from risk return perspective, including strategic management of interest rate and liquidity risks. So interest rate in terms of liability and liquidity risk in terms of asset, they are going to oversee. And what does the operational risk management committee do? So fraud risk management across the bank and provide recommendations. So operational risk is more about internal controls. And then what does the information security committee do? So they are going to manage the oversee cyber or information security across the bank and provide recommendation for IT strategy. Apart from the above, they have audit committee of the board to ensure review of the MIS related to compliance and compliance controls on a periodic basis before they are taken up with the board or committee. Credit risk, general disclosures for all banks. So this is the third pillar. Third risk we are taking, credit risk, and then the qualitative and quantitative disclosures. So the wholesale bank, retail and rural SME finance. So they are talking about the different segments. And their risk monitoring and reporting. So the early warning signals they have adopted, and the non-performing assets. So they are giving the details of the non-performing assets and criteria for treatment of accounts as NPA. provisions and write-off, and then the quantitative disclosures. So fund-based facilities and non-fund-based facilities they have, domestic and overseas, and then different industries they deal with. So this is to mitigate the credit concentration risk. So they are catering to almost 20 to 25 sectors. Digital and consumer loans, I think this is the major. Mortgage loans, digital and consumer loans, that is the major for them. So these are all the regular disclosures that they make. And then what are the credit ratings? As mentioned, Moody and Standard & Poor, that is what is there in the regulation, and they are using that. And then they are talking about the different ratings and the risk they assign to it. So if it is a AAA to AA rating, then it is only 20% risk. A rating is 50% risk. BBB is also 50% risk. BB to B is 100% risk. And below that 150% of risk. And then similarly for corporate loans, retail loans, different risk assignments. Commercial real estate 100%, non-performing 150%. Capital market exposures, and then off-balance sheet exposures, unhedged foreign currency exposures. Bank considers the following collaterals as eligible financial collaterals to claim credit risk mitigation after capital computation. I think we have covered what is a market risk. So, like, we will have a quick quiz session. So it's on our mobile phone itself. I'll just show one code.
Which bank has got the maximum better ratios, madam?
So it is going to be very versatile because every quarter they are going to disclose their requirements. So it will not be something static.
No,
So this is
as of March 24.
as of March 24. Maybe we have to check that which has them.
Try it again.
Yeah, can you try again?
Not the same.
Saying please wait for the presenter to activate it.
இது கண்டினியூ பண்ணுறாங்களா இல்லை அவள் தான்
இல்லை கண்டினியூ பண்ணுறாங்க இன்னும் கொஞ்சம் இருக்கு
அப்படிங்களா
அதுக்காக ஜஸ்ட் உதயம்
I have. It's working.
சார்
So I had a PDF of it, so we'll look into that. So these were the questions which I had placed in that quiz. So first one is about what are the three pillars of Basel III. So can you just try answering to it? We have options over. Oh, okay. Yeah. So what are the 3 pillars of Basel III? We have 4 options over here.
First one.
Option
Option A. So the second one is about the risks, and third and fourth are something else. So first one is about the minimum capital requirements, supervisory review and market discipline. So what does CET1 stand for in Basel?
Common equity tier 1.
Yeah, common equity tier 1 capital. Yay. So the business indicator calculation, so which is not part of the business indicator calculation. So whether it is lease, interest and dividend, or service component, or operational risk adjustment, or a financial component.
Basic indicator, not business indicator. You're talking about operational risk here, right?
Yeah.
It's basic.
So it's okay. Basic indicator. It's a method of calculation. So which is not a part of the basic indicator calculation. So which risk we do not take into consideration.
Service component.
What is financial component? I don't even understand what it means.
The financial component of the running of the business.
Sorry, I don't understand this. I'm sorry.
Yeah, so basically we don't consider the service component for the calculation. Other risks we are going to consider. So what is the purpose of the capital conservation buffer? To limit market risk, to ensure banks can absorb losses during the period of stress,
That's right.
B.
to increase operational efficiency, to support speculative investment. So ensure banks can absorb losses during periods of stress. So now what is the approach which is replacing the previous approaches? So we are going to be following that. So we now have this advanced measurement approach which is coming up, that is going to replace all the older methods like basic indicator for operational. So we will be having this advanced measurement approach in future for computation of our risks. So which instruments are excluded from the trading book?
Government bond.
Yeah, unlisted equities. It's actually unlisted equities which we do not include in our trading books because we are already assigning this for our government bonds. So how is the internal loss multiplier calculated? So we are going to calculate through risk adjustments, credit risk adjustments. We will be calculating the internal loss multiplier. So what are the two levels of capital adequacy requirements?
Risk-weighted and leverage ratio.
Group and solo level.
Group and solo level. So two levels is group level and solo level. Others are risks, and last one is the average, the computation, that is a computation.
%15%.
Yeah, so we saw this operational risk, we are calculating 15% of gross income. Which capital absorbs losses during liquidation? Common equity tier 1, additional tier 1, tier 2 or capital buffer?
See, can you just elucidate on this bank liquidation like Silicon Valley Bank?
Yeah, so this capital absorbs losses. We saw that in tier 1 is going concern capital and tier 2 is gone concern capital. So tier 1 you are going to absorb losses and still continue. Because of tier 2 is gone concern capital, so that is used for liquidation. So during liquidation you can absorb losses, but you will not be in a condition to continue your business. So tier 2 capital, it absorbs losses. So tier 1 capital is already over. All my losses are observed. Still I have some losses, so I lose my tier 2 capital. Tier 2 is already debt. So I am going to use my debt during liquidation. So how will I be able to continue my operation? So I am already using my
In other words, any capital reduction in any public limited company, it will amount to and reduce something like that.
Yeah.
This is assuming a stress liquidation, not a voluntary.
Not liquidation.
Yeah, in stress liquidation.
It's like restructuring, maybe. Bank restructuring kind of.
Yes Bank was an example. When they lost their tier 2 capital, they couldn't pay that. There's still a litigation, I think.
Tier 2 capital is an unsecured loan, right? No creditors can claim for it. It's a subordinate debt.
Yeah. 100%.
It's not it is not subordinate will be equity. The subordinate debt. Okay.
He's talking about tier 2 capital that is subordinated to all other liabilities. That's why it is the gone concern as you're talking about.
Subordinate to other liabilities.
If it is not subordinated, it can never come into the capital calculation. It is a liability.
So people ought to be very cautious while investing in tier 2 capital, right?
Absolutely.
Because there are some WhatsApp messages going, Karur Reserve Bank tier 2 capital, even IOB tier 2 capital, you are interested at a higher rate. So people should not invest, right? If
No, it should not, invest. There is a risk. Like Yes Bank, they had to suffer a loss.
Right.
They forced losses.
Tier 2 capital will have priority of payment over tier 1 capital. No?
So
it's like preference shares basically.
Axis Bank suffered loss because of S Bank tier 2 capital. Because it's
More risk, more reward.
Correct.
You put only in empty, inflation will wipe out all your whatever you earn.
Not necessarily. You put 50% FD, 50% RD.
Some ratio, but you cannot put.
It is same thing, 50%, 50% risk cover.
So what is the role of market discipline?
B.
option. Enhance transparency.
Yeah. So what is the role of market discipline? To regulate interest rates, to enforce transparency and disclosure, to manage operational losses, to calculate leverage ratios. So transparency. So market discipline is about disclosures. So to enforce transparency and disclosure. Which entity provides operational guidelines? So we all know that.
RBI.
Reserve Bank.
Hopefully not Ministry of Finance.
So value at risk. Why do we measure a value at risk? For which risk?
Potential financial loss.
Potential financial loss over a given time. What is a trading book instrument used for? So whether it is used for speculative investments or it is used for short-term resale, profit from price movements and hedging, or it is used for holding government securities, or it is used for long-term investments.
Short-term.
No, it cannot be speculative. It's a trading transaction.
What is BNC?
Short-term resale, profit from price movements and hedging.
It's definitely not holding.
In my opinion, it's speculative. You trade because you speculate. Otherwise, it's not a trade.
Nothing indexed.
I think C, I think so.
Holding government securities or long-term investments.
B.
Yeah, it's short-term resale, profit from price movements and hedging. That is why we are using this trading book.
Yeah, bow copy.
So, which pillar is for risk management?
All the pillars.
Risk management reviews. Which pillar is used for risk management? So, we saw this capital adequacy, supervisory review is second one, and third one is market discipline. So, which is for risk management reviews? 2. Supervisory review and risk management.
5.5.
Yeah. What is the minimum common equity tier 1 capital requirement? 5.5%. When did Basel III implementation begin?
2013.
2013. Which instrument requires RBI approval before shifting between books? All the instruments, all trading instruments require RBI approval before shifting between books.
That means from one bank to another bank.
Yeah.
Onto a securitized.
Securities. Debt securities.
What defines operational risk under Basel III? A is losses from failed internal process, people, systems or external events. Option B is losses from market risk fluctuations, credit losses due to borrower defaults, capital adjustments for risk-weighted assets. So, what defines an operational risk? So, it is about our internal processes and controls. So, internal process, people, systems or external events. So, operational risk is about losses from internal processes. What is the capital ratio for tier 1? That is common equity plus additional. What should we have? 5.5% plus 1.5%. I should have minimum of 7% as tier 1. Yeah. So that was it. So if we have any other points to discuss amongst us, we can raise those points.
I
thought you
Sir,
were
I was asking about cooperative banks. Yeah, please go.
So, I thought you were going to cover RBI regulations as implemented in Basel III. Are the ones that you discussed all this, they are the ones implemented by, the ratios that you mentioned, are they the ones that are currently the RBI norms?
Yeah.
I'm not familiar with RBI norms. So.
Yeah, so it is all from based on the RBI regulations. Maybe we'll have a look into the notification which they have given, the regulation.
I monitor all that, that's fine. All the ratios I'm familiar with, but I didn't know that they were the ones that RBI have, because Basel ratios are quite different. For example, Basel ratio, I think leverage is 3%, not 5. You mentioned 4.5, I think, something like that.
Leverage ratio.
Yeah,
leverage ratio.
LCR.
And there are, of course, there are NSFR ratios which I didn't see here. I saw LCR, but
yeah, net stable funding.
Right.
100% they have required.
That's the RBI regulation, right?
Yeah.
Okay. So all of the ones that you mentioned here are the RBI.
Are the RBI requirements?
Okay, I have a question. Like we have so many ratios. So, see, they are reporting as on the balance sheet here. Like, so how frequently do they have to review that these ratios are met?
Yeah, so quarterly disclosures are required.
Yeah, like I understand. Like for listing, see, listed entities, they like internally, in a bank's perspective, internally, when do they do it? Like is it quarterly? Or?
So internally, they should be regularly revisiting it. So quarterly is only the disclosure. So anytime any of my ratios might
I can help answer that because I was doing this for donkey's years in a foreign bank. What they do is you are supposed to maintain, that is what ICAP is for, to make sure that you are always well above what you normally require. Like we saw in IDFC Bank, they are the 13+%, right? So the minimum, in fact, we used to have in a bank I worked, at least 2-3 percentage points well above even those norms, right? So you never know, as someone else mentioned, something happens, your NPAs go up and your ratios can fluctuate in a crisis very significantly. So they maintain tremendous amount of reserve in their buffer internally. So they don't have to worry about monitoring daily. But having said that, for liquidity, LCR, there should be daily monitoring to make sure that, because the LCR is to do with the liquidity and the banks have to be very, very liquid. So this 30-day LCR needs to be monitored. The systems ensure that happens. So, but whereas the other credit risks, etc., that is governed by the limits, and they would not have, everybody would have certain budgets and they cannot go above that. So they make sure that that will never be the case. So your concern is between 2 quarters, can the ratio go down? It shouldn't. It cannot, because the next quarter, the risk is, your worry is, can it go down in the next quarter or as we go along, right? Because they have this buffer, it will never happen. It should never happen.
Thank you.
Yo.
For all the banks, it is same only, 9%. Some bigger banks, like notified banks, some difference, like SDFC, ICICI. Same only.
No, the minimum capital requirement is going to be the same. Only counter-cyclical capital buffer will differ based on the regulations.
Regulator. For some specified banks, that's what happens.
Which one? Minimum requirements.
No. I think
no,
this
minimum
question
plus
is
CCB is 11.52. So CCB is for some different banks or all, like notified banks?
No, this requirement is minimum for all the banks. Yeah.
Has RBI given any, have they identified systemically important banks, HDFC and ICICI? Have they declared or no?
Yeah, systemically important banks are declared based on the capital.
Now, which are the ones? Do you know?
Systemically important banks.
Like HDFC, SBI.
There are 3 in India, sir.
Sorry?
SDFC, ICICI, SBI.
ICICI and
HDFC.
So my question is for these 3 also 9% only or higher?
They have a 0.2 to
0.8
extra.
Systemically important.
And what about counter-cyclical buffer? Have they announced anything at all or no?
No, counter-cyclical buffer now, as of now, it is not there.
0.
It is open. Anytime it will come. So if we have any other points for discussion, we can do, otherwise we'll...
Thank you.